In today's class, you're welcome once again to my teaching. Um, just like what I've promised, I will do well to be teaching you on some concepts in what you can really add to your trading method that can make it better. Right. This particular teaching is what I've done before on liquidity graph and trap zones. Right. And if you remember vividly, right, when I did this teaching, then I was making use of indicators, all right, to teach. But now I will not make use of indicators. I will just teach with a plain chart, right? I will teach with a plain chart. So this will make it clear for you and for you to take liquidities, right? Well, I have a concept where which I call a ELPC. So this is the foundation of that ELPC, all right? So I'm not going to show you what ELPC is. I will just show you the foundation of that. You can study my flashcard and for you to build on that. All right, today we're going to be looking at liquidity zones or trap zones. Right, what are liquidity zones and what are trap zones? What are liquidity zones and what are trap zones? One thing you should know is that the market will not move, right, or else liquidity has been taken off the market or off a particular zone, right? If liquidity is not taken in a particular zone, this particular market will not move. So, what are these liquidity zones? What are these liquidity zones? What are these trap zones that you should take note of? Right. Many of you are already aware of probably the rotary style of trading, BTMM style of trading, and any style of trading that use uh, support and resistance. Right. When the market have support or we have resistance, right? Or in a situation whereby we have equal top, right, or equal bottom, which we call W or M's. This is what BTMM always trade, M's and W's, right? Or a situation whereby we have a swing high or low, or a situation whereby we have this is double top and this is double bottom, right? We also have swing high or low. So these are areas where people always sell or buy from. Okay, for example, look at this resistance. So many people have been trained that when market gets to resistance, right, they are looking to sell there, right? And when market gets to support, that is where they are looking to buy, right? So that is how many people have been designed. That is what they've been taught, that buy at support, sell at resistance. And this is what people have been doing, and that is more of the reason why they are losing their money. This is what liquidity providers know, just like the name of my concept, which is called liquidity providers because concept, because we trade based on liquidity, right? If liquidity has not been taken, we are not going to trade. So these are the basic concepts that you are going to understand in the market for you to trade effectively. Just like what I said, many people have been taught to trade from support, buy when the market is in support, and sell when the market is in resistance, right? So this implies that when people are selling off this area, right? Please listen to me attentively. When people are selling off this area, right? That shows we have a whole lot of traders that would have put their sell stop, I mean, buy stop here, right? And people that are already selling, right? They are going to put their stop loss also in this area. So this now becomes a liquidity pool or a liquidity zones or a trap zone, right? This now becomes a liquidity zone or a trap zone, right? Because many people are already selling off this area and they've already put their stop loss here. And just like what I always teach is that when you put stop loss for your sell trade, that automatically implies that you want to buy back your position when the market change against you. So this shows that you are selling this market and you are saying if this market comes to this particular area, then your position should close. That shows you are willing to buy this market at this particular area because you are selling this market. You know, this is how the market works. You buy at a very cheaper price and you sell at a very expensive price, right? You buy at a very cheaper price, then you sell at a very expensive price. So this shows that if you think that you are selling at this expensive price, then you say that okay, if market should get to this area, that shows that the market is not going your way. So this particular area is more expensive than this area. Let's say, for example, this area is $10, right? $10, and this area is $5. Then you are willing to sell at $5 and take your profit at the support zone, which is $1, right? Which is $1. So this shows that your stop loss is there, and you are saying that if this market should reverse against you, then this market should take you out by buying the position back. So you are selling the position. So you are saying that if this market gets to this area, you should buy the position for you at a very expensive price. This is your stop loss, right? Many people always put stop loss, but they don't understand the reason why their stop loss is there. Your stop loss simply means a buy stop if you are selling a trade. And likewise, when you are buying a trade, your stop loss here simply means a sell stop, right? It simply means that you are saying if this market break through this zone, right, and come to this area, this is your point of invalidation, right, which is invalidating your market, then the market should buy the market for you at a very cheaper price, right? That shows, or the market should sell the price for you at a very cheaper price. Now, you are selling the market, you are buying the market at the rate of $1, then you put your stop loss there at the rate of 50 cents, right? Your stop loss is there at the rate of 50 cents. So you are saying that if the market should come against you, then it should take you out on a stop loss, which is actually a sell stop, right? Your stop loss is a sell stop here. And when you are selling, your stop loss is a buy stop. So likewise, we have many traders that are breakout traders, right? They are breakout traders. Are you following me? They are breakout traders. Now, these breakout traders, they are going to put their own buy stop here. That shows your own stop loss, which is a buy stop, is already sitting around this area, which makes this area a trap zone or a liquidity pool. That shows there is a lot of money sitting down here. We have a whole lot of traders that are willing to buy this market at this particular price, which is a very expensive price. Are you following? You know, I said that this particular zone is your stop loss, which automatically means a buy stop, right? So market, many people will have actually put their buy stop here or their stop loss here, which also implies that that is a buy stop, right? So you are willing to buy this market at a very expensive price instead of you selling at a very expensive price here. Now, this now means that when market this is actually what I want to say, that the liquidity providers, they are also looking for a means to sell the market at a very expensive price. Are you following? You know, I already tagged this particular area as $10, right? I already tagged it as $10, and you're already selling at $5. And the liquidity providers, they are going to sit and think, okay, we have a lot of people that are willing to buy this market from us, and they are willing to sell. So where do you think they will go to? They will go to the area where there is a lot of money, which is the area of support or resistance, because we have a lot of people that have already put their stop loss there, which is their buy stop, or at a support level, which is their sell stop. So at this area, they are willing to sell at a cheaper price. So the market maker or the liquidity provider, they will come to buy this market at a very cheaper price for them to go higher. And for a sell trade, they will break through this resistance to buy this market at a very expensive, to sell this market at a very expensive price, then they will shift the market. So this is the concept that we call the induce, trap, and shift, right? I'm going to explain the concept of inducement. So the concept of inducement is that many people, they are already induced to say that, oh, this is a good zone to buy this market from. So they are breakout traders. Their buy stop is already here. So they will induce them thinking that, oh, this particular resistance will hold, and the market breaking through that will buy up. But they will induce more people to buy in this market. After inducing them to buy this market from here, then they will shift the market away from them. So this is what we call the induced trap. They will trap them here and they will shift the market, right? So this is in the case of a resistance and a support. Now, we also have equal top or double bottom or double top, right? What is it with double bottom and double top? Double bottom and double top is that many people have already seen this as M, right? Double top. So they are willing to sell this market at this particular area, right? And market, they are believing that the market should shift away. They already put their stop loss here, which is a buy stop, and many people they already buy this market. They already put their stop loss here, which is a sell stop. So the liquidity providers they are going to move the market against them, right? Just to induce some other buyers, right? Sellers are already in this market. They've already induced them with this particular resistance, and they already induced buyer also with this particular resistance just for them to buy on the breakout. So they will come here and they will buy this market. They will sell this market to them because just like what I used to say, we have two participants in the market. We have the buyers and the sellers. So when there is a buyers, right? When there are buyers, there will surely be sellers, right? That shows we have two people in two particular activities in the market, buying and selling. That shows there is nobody that will say that okay, I come to the market and I'm unable to buy. You will surely see someone to buy from you, right? Or you will surely see someone to sell to you. So this shows that the market maker or the liquidity providers, they'll be looking for a cheaper price for them to buy this market. So they will come to buy at a cheaper price and they will go higher to take their profit at a very expensive price. So this is now the concept of buy low and sell high, right? Buy low and sell high. And in this particular area, they've already seen that many people already put their buy stop here. So they will go there to do what? To sell high and do what? And buy low. So this is what liquidity providers always do. They will look out for where the little traders will put their own stop loss or their buy stop. So they will go there to sell to them. Then they will reverse the market and eat their stop loss. So that is the concept of liquidity providers and trap zones and liquidity zones, right? So this is what you should take note of. Then we also have people that always make use of trend line. We have trend line like this. You call this probably a falling wedge or whatever things they are going to call that. Whatever pattern the little traders surely have in the market, where they are expecting to buy that market from, you should know that that is a liquidity zones. The market will break through that, then reverse, right? Market will break through this, then reverse. So most of the reason why you will put your stop loss and you will see that your stop loss is rated. So I love using this statement of Steve Marrow that said that do not trade when the stop loss has not been rated, right? So until you see a stop hunt, that is when you should trade the market. And this is very similar to this, that until you see the liquidity providers taking out the liquidity zones or the trap zones, then do not look to buy the market or to sell the market. Right. I hope that is taken. So these are the rules, right, of liquidity trading style. These are the concepts I use in the market, and this is the way I trade. Without seeing liquidities, I am not going to trade the market or buy the market. Right. So we have six major trap zones that we have. Six major trap zones, six major liquidity zones that I always make use of. I don't use all these particular wedge, falling flag, all those things. I don't use them. I just use major six, and that is what I'm going to base my teaching on because I don't use others. I just use these major six trap zones, which I'm going to list for you, and you should pay attention to them. I have six trap zones I trade. Number one, I have daily high and low, right? Daily high and low. Number two, I have weekly, right? High and low, right? Number three, I have monthly high and low, monthly high or low, rather. Number four, I have yearly high or low. So these are the zones I trade. Yearly high or low. And number five, I have equal high or low, which is called M's and W's, right? Number six, I have swing high or low. So these are the zones that I look out for. Now, we have the first four. How do you identify them on your chart? How do you identify these four on your chart? Now, how do you identify daily high or low? You can make use of your daily candle, 1 hour time frame to view your daily high or low, right? Pay attention to the details. I'm still going to show you on the chart. As I'm speaking, kindly write it down. You can view your daily high or low on a 1 hour time frame. You can view your weekly high or low on a 4 hour time frame. You can view your monthly high or low on the daily time frame. You can view your yearly high or low on the weekly time frame. Right. Daily high or low on the 1 hour time frame, weekly high or low on the 4 hour time frame, monthly high or low on the daily time frame, and yearly high or low on the weekly time frame. Right. So equal high or low, you can find this on any time frame. Swing high or low, you can find this on any time frame. So quickly, let's go to the chart and identify what we are talking about. Right. So let's quickly go there. Now, just like what I said, now I'm using MT4, right? I'm using MT4, right? Because I use this most times, right? So when you're using MT4, if you click on, right, on your computer, Control Y, is going to take out the period separator, right? And if you click on Control Y again, it's going to give you period separator. So this is what we're going to focus on. Now, you go to 1 hour time frame. On 1 hour time frame, let me remove this indicator. Right, on 1 hour time frame, within this period is a day, right? This period between this line and this line is a period, is a day. This is a day, this is a day, this is a day, this is a day. That's between period, between this line and this line is a period, which is a day. Between this line and this line is a period, which is a day. Within this line and this line is a period, which is a day. Within this line and this line is a period, which is a day. Now, just like what I said, then you can also use 4 hour time frame, right? So within this line and this line is a period, which is a week. Within this line and this line is a period, which is a week. Within this line and this line is a period, which is a week, right? So for that's for you to view your weekly high or low. Now, for daily high or low, all right, which is, I mean, for monthly high or low, within this line and this line is a period which is a month. Within this line and this line is a period which is a month, right? This is a month. This is a period of a month, period of a month. Can you see that? Then we have a year, right? Within this line and this line is a year. Within this line and this line is a year. We have a year, right? This line and this line. So this is how you view that. Now let's now see the liquidity graph. Let's start from the daily and let's see how the market take out the daily high or low for us to work with. Now, this is a very simple thing. This is yesterday's low, right? Can you see this daily low, right? Then you will see how market take out liquidity from that, then reverse. Can you see that market came to this low, take it out, then reverse? Now, this is this daily high. This is this daily high. Can you see this particular day high? Market came all the way up, take out the liquidity, then drop. Can you see that? So this is how the market works. Market always move when there is liquidity, right? If there is no liquidity graph, the market will not change direction. Can you see this daily high? Market came all the way down here, take out this liquidity, then go up. So you can see this. It is not every time that the market will surely do that, but some of the time, this market will surely give you that liquidity graph, then reverse. So this is daily high or low. You can see how the market is working through the high or the low. Now, let me give you a specific rules concerning this. For you to really count it as a liquidity graph, right, you need a single candle to take that high out, just like this one, right? A single candle, right? A single candle was the one that took this high out, right? It must not exceed 2 candles, right? Take note of that. It must not exceed 2 candles. But the one I love seeing most is when a wick actually took it out, just like this. Can you see a wick? The candle did not close above it, right below it, rather. It just pierced the low. Then we have the market reversing. So with this particular area, if you have your entry rule, just like my group, we have an entry rule how we take this particular setup. So the market, we are expecting it. You can see this on my flashcard. This is what I trade even all throughout last week. I call this ELPC, though we have some major rules around this. This is not the only thing we are doing, right? We have some rules around this that will make us to catch this particular low as low as this area. Then you are actually expecting the market to go as far as that. Now your stop loss will be as tight as this. Now I'm not asking you to enter this market immediately. We have this. No, there are some rules of entering. It's not every time that the market pierced it like that they are looking to enter, because you don't know if the market will still reverse again and continue to go down. Then you will blow your account rather than growing it if you are just trading it anyhow. There are some rules and there are some patterns we always look out for, right? There are some rules and patterns that we always look out for. Now, this is another one. Can you see this eye? Look at how it was pierced, right? The market reversed, then the market came also all the way up here. market took it out and like something like that. Look at this low also, the market take it out and went up. So that is taking out liquidity. Then we have the weekly high or low. You can practice this on any time frame. So I mean on any pair, right? I'm just using this as an example, right? Look at this weekly low. This was last week low. Then the market pierced it with a candle, right, and a weak candle. Then the market reversed. So these are the things you are looking out for before you trade, and for you to be successful in your trading career. You make sure that markets take out liquidity before you trade. This was just a single candle that took out this liquidity. Can you see that? We have just a single candle, right, that took out this high, right? Can you see that? We have this one also. Can you see how the market is just taking the high and low and the market is just reversing? Can you see that? Even though this actually is a three candles, we have a rule concerning that also. Then look at this, just a single candle. Can you see how the market was reversing? So with this, you see how many profit you would have made, right? Can you see this? Pierce this, went down, right? Then we have another one that pierced this. Even this one pierced this. Can you see how the market is taking out liquidity before it works? So there are some rules that are guiding this that will ensure that you trade effectively, right? There are some rules that you have to guide, but the basic of this particular trading is just to show you how the market moves. So the market will not move until there is liquidity. Now the next one is to check the monthly high or low, right? To see the monthly high or low, let's quickly see some other example. Now the pattern appears everywhere, right? The pattern appears everywhere. You can see it everywhere, and in any kind of market. Now, this was last month. This one, this was the beginning of the month. That was this particular one is the beginning of the month here. Market take it out. Then look at how market reversed. See this one also. So this was last month high or low. Can you see how the market took out this low also? Can you see how it reversed? Right. So these are what you are looking at. So this is an example of a swing high or low. This is a swing high, right? Because this is too far. When this is too far like that, you cannot consider it again. This is more than a year, so you can't consider that again. So you consider this as a swing high. Look at how market pays that, and look at how it reversed. So this is basically what you are looking for in the market for you to trade effectively. Now, now look at this. This is monthly high. Look at how market took it out, then go down. You can see this everywhere, anywhere. Look at this one also. Market took it, then went up. Look at this one also. This is a monthly high or low. This one, monthly high. Market took it out, then go down. Right. So these are what you look out for you to trade much more effective. Now, the beginning of this month, look at how market. Okay, market did not take out the high. This was the high of this month. The market did not take it out at the beginning of this month. But look at this. Okay, market did not take out the low also. But you can just see this everywhere. This is just a pair that I'm showing you. Then lastly, the yearly high or low. Now you can see last year low was taken out by what? Two candles. Just like the rules I gave to you, I said it must not exceed two candles. Right. Look at it. Market took it out. Can you see the reversal? So these are these are awesome, right? This is a swing high, not a yearly high. Right. That's a swing high. Right. Look at how market took it out, then drop. Can you see that? So you can see this everywhere. You can see this way everywhere. Look at this yearly low was taken. This yearly low was taken. Can you see that? It was taken. Right. Look at this bullish move. So at the beginning of the year, you already see that market was coming down and taking out this low. You know that for the rest of that year, you are going to buy that pair. So this is the wisdom behind swing trading and trading effectively. If you know this and you know how to catch it, then forget it. You are done forever. So you can find this anywhere. Look at this. Can you see this? Market took it out. Can you see how the market dropped for the rest of the year? Now the market opened for the beginning of the year. Take out the last year high. Look at how market dropped. Right. If you link this with my AMD video that I did, it will make sense to you. Right. That's another rule that I combine with it. Accumulation. Right. We have accumulation, the manipulation, take out the high, then distribution. Very, very awesome. Look at the beginning of this year. You can see I'm just using a pair, not to compare to all pairs, and you will see the beauty that is behind this. Can you see this? Using the AMD rule, market beginning, right? Accumulation, manipulation, the beginning of the year, right? Then distribution for the rest of the year. So you are buying this market as low as this area, then this is month of February that you are buying this pair, right? Month of February, then you are holding it till December. That is the secret of swing trading, right? Look at this low also. Look at this low. Can you see this low? Right? The market open. This was accumulation. We count this as accumulation now. The market distribute. Can also consider this as reaccumulation here, right? The market manipulate, take out this low, right? Last year low. Look at the distribution. That is a secret. Can you see this? So very, very awesome. If you backtest this, build a system around this with all what I've taught you, you will see the beauty behind this. Then we have equal high or low. You can spot them your double top, double bottom for you to trade much more effectively. Then swing high or low, just like I showed you. This is an example of this is another yearly high. Can you see this? How the market took it out? The market opened, the market took it out. Then, so you can easily predict the beginning, what will happen at the beginning of a week, right? You are going to predict. That's what we do. We can easily predict what's going to happen for the rest of the week. If the market open, then what the market did was just to go higher to take out last week high. You know that for the rest of that week, you just need to build to find a way, entry rules around that area for you to trade that pair for the rest of the week, for the rest of the year, for the rest of the month, right? For the rest of the day. So these are the secret behind power of three, manipulation, taking out the high, then you are going to build a system and you are going to be you build that particular arsenal to become very, very successful in the market. So, guys, this is a secret that I would like to share with you in how the market works. These are concepts, the liquidity provider concepts. We have a way of working around through this area for us to catch this top bottom, right? Then you can actually trade it for the rest of the week. This particular top and trade it. You can see how market took out liquidity here also. Can you see this? Just a secret. Can you see how market pays that? Right. So this is a fantastic way of trading. This is the accumulation. The market was accumulating here for about many months. Then we have manipulation at the beginning of 2018. Take out the high. Then you can see the distribution. Look at this. Market was accumulating here. The manipulation. Then we can see the distribution. So when you know this, you are okay forever with this particular concept. You can see this low also. Look at this low. Can you see how the market took it? Right, then distribution. So you're just working around liquidity and finding a way of how liquidity works for you to be effective in your trading. This is awesome and this is fantastic. I hope you are going to appreciate this and walk around through this area. All right, guys. Thank you very much for joining in. Right. So I will give space for question and answer, but it will not be recorded in this section. Thank you so much. All right, you can do well to subscribe to my YouTube channel, right, and join our Telegram channel where we post our setup, and you will learn much more from our setup, right? You learn much more from our charts that we're sending, and you'll be able to build a very fantastic system around this method. So this is a secret in the market that nobody knows, right? So you can learn from this. Then you can do much more to get more of this secret to join the mentorship group, right, which is just about 350 for now, right? The admission is still open for the month next month, so you can join in and join us and have a wonderful trading day, right? I'm still receiving questions. You can ask me questions based on this and be okay. Thank you.